Hey everyone, so in this lesson we're going to be discussing bank reconciliation, what it is, how to do it, what are the journal entries that come with it. So bank reconciliation is something that has to be done at the end of typically at the end of every month. I guess it could be done, less often than that, but generally speaking, we do it monthly. The bank statement and our own records. Now, what exactly does that mean? Your bank statement is basically showing you every single transaction affecting your bank account, which is your cash, really, over the course of the month. But it only shows you the information that the bank actually has. So there are certain things that either are not on your bank statement yet, right? Or may never show up on the bank statement, but that did actually affect your cash. I'll give you an example. If somebody comes to your store and pays you in cash, well, your cash has increased, but your bank has no idea. And so there's a discrepancy now between how much cash you actually have and how much cash your bank says you have. Then on the other side, there's what we call the book balance. And that's your own records. That's your own bookkeeping. And again, there are certain things that have affected your actual cash balance that are not in your books. And that would be something that would appear on the bank statement potentially, but not in your books. Like, if the bank charged you a service charge for the month of $10. Well, if you look at your bank statement, you'll see it there. Oh, a $10 charge. But it's not on your books because you didn't put it. And so part of this whole process is going to be taking that information from the bank statement and putting it into our own records, into our books. And the goal here is to take these two balances, which are both technically wrong, the bank statement balance and the book balance, reconcile them to figure out what the actual or the correct cash balance is. Now you can see in this example that I have right here, this is kind of what it looks like. It's basically a statement. You start with your balance as per your bank, and you make any necessary adjustments to get your correct cash balance. And then you do the same thing for the books. You start with your book balance, you make all the necessary adjustments, and you see that in the end, the two will have the same cash balance. That's how you know you're doing it right. Now, what are those adjustments? For the bank, your adjustments are deposits in transit, first of all, have to be added. These are deposits that have not yet made it to the bank. They're in transit. So this could be a check that you deposited the morning that your statement was printed, so it's not on the bank statement. This could be a check that you have in your pocket that you haven't gone to the bank to deposit yet. This could be cash that you received that you haven't deposited yet. So any money that you've received that you haven't yet deposited, whether it's cash or check, you would add it to the bank balance. Next, you've got outstanding checks. This is kind of the opposite. An outstanding check is a check that you've written to somebody else, but that person hasn't cashed it yet. So the moment you give somebody a check, you've basically given them cash. But if I don't cash the check that you've given me, then the money is still in your account. Well, that's the adjustment there is you need to subtract it because truly that money doesn't belong to you anymore. So you need to take it out of your bank balance. And then plus or minus any bank errors. Sometimes banks make mistakes and you would have to adjust those errors. And that would give you the correct cash balance. On the book side, you start with your balance as per your books, which is your own, what you think your cash balance is, and you add any deposits by the bank. So you look at your bank statement, and if the bank put any money into your account, you would want to add it to your books. Then you want to subtract any service charges. If the bank charged you any money, you look at your bank statement, you'll see it, you subtract that from your books. NSF checks. An NSF check, NSF stands for non-sufficient funds. This is a check that was given to you by a customer or by somebody, and that check ended up being refused by the bank because the other person who wrote the check didn't have enough money in their account to honor it. And so, unfortunately for the person receiving the check, that money will get deducted from your account. If I give you a check for $500 and I didn't have any money in my account, then you don't actually have the $500. So you would have to deduct that from your book balance. And then any book errors. Again, if we made any errors while bookkeeping, maybe an error while writing a journal entry or something like that, that would also have to be adjusted. So we're going to work on this exercise right here. So I'm going to start by I'm going to follow this format here. So this is Miller Limited. So let's go with, and I'm doing this on Excel mainly because it's neater. You could do it by hand as well. If your exam is by hand, you should probably be doing this by hand, but it's going to be neater for you if I do it on Excel. So we're doing a bank reconciliation. And we're doing this for the month of June 2025. So we could say June 2025. And now we're going to start with our balance per bank statement. That just means your bank statement balance. Let's make this a little bit bigger. And it says here in the question that our bank statement balance is $21,255. So that's what I'm going to put up here, $21,225. And then we want to start with any additions. So really the only additions you might have would be deposits in transit or potentially any errors. So let's take a look at what we have. We have an electronic collection of a note receivable, including $500 of interest. So this is a deposit. This is not a deposit in transit. This is money that the bank collected for us. An electronic collection would be like somebody sent you an e-transfer or a Venmo. So it was automatically entered into your account. So that's not what we're looking for here. Outstanding checks, no. Cash collected from a customer, not yet deposited in the bank. That's the one. So we have a deposit in transit here, and it is $4,500. Okay, great. So we're going to put that over here. And now we want to see, do we have any outstanding checks? Really, that's the only subtraction from your bank statement. So I see outstanding checks there, 9,000. Outstanding checks. So minus 9,000. Our corrected cash balance would be, right, if you do 21,225 plus 4,500 minus 9,000, I should have actually 16,725. Then we want to do that again, balance per books. And this, our books think we have 12,000. So our own records say we have 12,000. And then we want to add, first of all, any collections by the bank. So that electronic collection of a note receivable, I'm going to add it, but I'm going to add as two different things. So I have a note receivable collected, and it's 5,500. And I'm also adding the interest collected as 500. I don't think you have to separate them, but I'm separating them because it's two different things. I collected a note, but I also collected interest. Then I don't have any other additions, so we're going to put those two together. So 6,000 is the total. Then we have deductions. I see the NSF check. So NSF check, customer number 441. We are losing $1,200. You want to deduct, like I said before, you always subtract your NSF checks from your account, from your books, and then anything else. The bank service charge of 75. Bank service charge, so 75. Great. So we'll put those two together. So we have total deduction of $1,275. So now if we put these two together, 12 plus this minus this, 16,725. And I know that this is right now because I see that I got the same answer for both of them. So now I'm going to format this a little bit by putting a $sign on the first number of each column. And then on my two totals, there. Your goal at the end of the day is for those two to be the same. If your format is a little bit different, that's okay, because this is not an external report. It's not something that is governed by IFRS and you have to follow a specific format like an income statement or a statement of financial position. This is an internal document. So if it's slightly different, it's fine, but you need to have the same totals in the end. Now, bank reconciliation doesn't stop here. Every adjustment that needed to be made to your books, so I'm talking about these four things here. Each of these need to actually be recorded in your general ledger. They need to be journalized, basically. And so that's the next thing we're going to do. It says to prepare for each adjustment, prepare the necessary journal entry. So we're going to go one by one here. And basically the idea here is really, really simple, guys. Every single one is going to affect cash because this is an adjustment to your cash. And then think of, all the journal entries you've learned, all the different accounts. We're going to just use what we know here. So note receivable collected. Well, when you collect a note receivable, what do? You debit cash. So this is an asset that's increasing by $5,500. And you credit the note receivable. This is an asset decreasing by $5,500. What I'm saying is that the actual recording portion of a bank rec is not any different than any of the other recording you've done so far this semester. Interest collected. Okay, interest collected. I got cash, $500, and I'm collecting interest. So interest revenue, which is a revenue, $500. That's simple. Now, NSF check from a customer. You need to think about the most appropriate account here. I'm going to put you in a scenario. You have to think of the account, okay? A customer owed you $1,200, gave you a check for $1,200. So you thought the customer paid you, right? And now that check came back. So that customer owes you money again, right? What would be the appropriate account for that? What would be the appropriate account to show that this customer owes me $1,200? Now, if you said accounts receivable, you'd be right. So I'm going to debit accounts receivable here, which is an asset that's increasing by $1,200, and I'm crediting cash because this was a reduction or deduction. Look, these two are both going to be credits to cash because we're losing the cash. These two were both additions to cash because we gained the cash here. Finally, the bank service charge. I would just call this a regular expense. So you can call it like a banking expense or something for $75, and we are losing cash for $75. Okay, so even if you're not writing journal entries, you still have to know everything I just put, right? You have to know that it was a cash that was increasing. Cash is an asset. And that it was increasing by $5,500. That note receivable is an asset that was decreasing by $5,500. Every single adjustment to your books only. Never write a journal entry for this, guys. Never write a journal entry for your bank statement because that's not your job. That's the bank's job. Okay, and even at that, like nobody's writing a journal entry for the bank statement because you're not keeping record of that, right? You're keeping record of your own books, and so only the book adjustments require a journal entry or require them to be recorded in your books. Okay, that's bank reconciliation. It's not very difficult. Practice it a little bit so you can see different scenarios. But that's what it is in a nutshell. Your goal is always for these two. And that's what's good about, that these two have to be the same. And so you can basically keep working at it until they're the same. And sometimes it's just a matter of like, oh, you made one number positive instead of negative, and you play with it and you get the right answer. If you have any questions, let me know. See you at the next one.